On the first Tuesday of the month, where the nation stops for a horse race called the Melbourne Cup, the RBA have met and they've kept the cash rate on hold at 1.5%. Now, the cash rate hasn't moved since August of 2016, so obviously the RBA are feeling quite comfortable where they have the cash rate. And the reason for that is that the lenders and the regulators have been doing the heavy lifting. We're doing out-of-cycle interest rates, which has basically taken the pressure off the housing market, but it's also meant that potentially for lending for business, which will stimulate economic growth, is still available at attractive interest rates for those looking to invest in their businesses. So I thought I wouldn't do the fly around in terms of the economic numbers. I wanted to focus in pretty much on the housing numbers as we are just most of the way through the spring selling season. So let's have a look at a bit of the data provided by CoreLogic, and this is their October numbers. Let's go through them as we speak. So quarterly numbers across all of our major capital cities. We did see Sydney's quarterly result in a negative 0.6. So property prices have moved across the Sydney basin by negative 0.6 over the last quarter. Melbourne, on the other hand, continues to be growing, and that quarterly number is around 1.9%. So although the October number was a little bit softer, it definitely is still a very, very much a moving market. Brisbane is also a moving market, up 0.6 of 1%. Adelaide also up slightly at 0.1 of 1%. And then we had Hobart in the same category, just a little bit of a tick up at 0.1 of 1%. Darwin has been the negative. So we're basically seeing the Darwin market move down negative 4.4% over the quarter. Canberra is up 1.1%. And again, also in the red is the Perth market, down 0.7 over that quarter. So again, they are just snapshots. Let's look at the yield numbers now. So take a look at the national snapshot. What we're talking about here is houses. So the housing yields that we're seeing across Australia are around 3.5%, for units around 4.1%. But again, we can't buy the Australian property market in terms of the rental yield. So let's dig a little deeper. In the regional areas, we have seen obviously still better, more attractive rental yields. So if you're chasing cash flow, these are the marketplaces that you look at. So houses, 4.9%, units 5.2%. Across our capital cities, with obviously a lot of growth in some of our bigger centres, the overall capital yields that we're getting in the capital cities for houses, 3.1%, and for units, 3.9%. So units always still attracting a little bit higher rental yields. Now let's dig deeper into the capital cities. We'll do around the nation. So let's start with Sydney. Housing rental yields around 2.8%. For the unit market, they're around 3.6%. Melbourne is the lowest for houses in terms of rental yields at only 2.6%. You can still find better value in that market, but that's the sort of mean average that we're seeing here. Units 3.9%. Brisbane houses 4.2%, for units 5.2%. So still an attractive rental yield in Brisbane, but be careful with the oversupply that's going to hit in 2018. Some of those yields might come down a little bit. In terms of Adelaide, we saw houses at 4.1, units at 5%. Canberra also houses 4.1, units a little higher at 5.3%. And then we've got Perth. We're looking at houses at 3.8 and units at 4.3%. Hobart, definitely one of those yielding markets where we're sort of seeing houses at 5% and units at 5.1% yields. And Darwin, just to round out, is the most attractive, and that's probably because of the decrease in the actual value, where you're seeing houses having 5.8% rental yields and units also having 5.8% rental yields. So if you're after cash and you want to sort of buy at the bottom of the market, these are the more aggressive markets that you can go into. So as the values continue to grow in Melbourne, the rental yield pressure might continue, but we are definitely seeing, obviously with a correction of starting in the Sydney market, some of those rental yields will start to improve in that particular market as well. Now these, obviously Melbourne and Sydney, population growth is a big story for those two markets. We're still seeing very, very good economic growth in those two centres, and that's attracting the population story. Melbourne, sort of 1,500 people a week moving there. Sydney, around 1,100 people moving there. So they are big numbers, and they can obviously absorb some of the rental vacancy stock that's out there as well. If Brisbane can start to get its economy moving, hopefully that will see the unit oversupply being absorbed quicker than we anticipate. So overall, the property market is definitely starting to slow down from its heights all led pretty much by the lending restrictions that we're seeing in the market. So on balance, as we move into the end of the spring selling season, the market's holding up reasonably well, but we're certainly not going to see the momentum that we saw 2016 and into 2017. We are going to see a slowing property market in terms of capital appreciation. So again, it comes down to where you're buying, why you're buying there, looking at the fundamentals of supply and demand and getting all of that story right to get the best opportunities. Do your research, make sure you select well, and if you're not quite sure, you can always reach out to us and we can help you out in that space.